Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Today, the company that you are analyzing is 20 Microns. So let me begin with a quick overview of the company. So 20 Microns is one of India's most trusted names in the industrial mineral space with over 30 years of presence. They serve a wide range of industries from paints and polymers to rubber and ceramics through a highly customized product portfolio of more than 500 formulations. What sets them apart is their integrated model, combining their mining assets, large-scale mineral processing, and in-house R&D, which allows them to consistently deliver quality and reliability across markets. So today, with operations in 65 countries and 9 manufacturing plants, they are not just a legacy mineral company, they are evolving into a high margin innovation led platform, especially through their growth in nano materials and construction chemicals. Let's now look at how their revenue is distributed across industry and geographies. So, starting with the revenue contribution by segment on the left side. So, the company continues to have a strong foundation in the paint sector, which contributes about 48% of their revenue, which is followed by polymers at 25% and rubber and paper at 9% each. Ceramics and other round out the mix with 5% and 4% respectively. So while paints remain the dominant vertical, there is healthy diversification across multiple industrial use, which adds resilience, especially in cyclical environment. Now looking at the geographical revenue mix on the right, exports have consistently contributed between 13 to 16% of the revenue in the past 5 years. In FY25, exports stood at around 13%, slightly lower than prior years, mainly due to global freight disruptions and a shift towards bulk shipments. However, management expects export share to recover to 16 to 18%, especially with the renewed focus on Asia, Middle East, Latin America, and stabilization of logistics. The domestic market, meanwhile, remains the core revenue engine for the company, contributing 87% in FY25, anchored by the strong network of 9 plants and 15 warehouses across India. Let's first understand some of the companies which have under our group structure. So on the left, we have our core subsidiaries. 20 Microns Nano focuses on high margin nano minerals and specialty additives, a key future growth engine. 20 MCC manufactures construction chemicals and also mineral based agri inputs like soil conditioners, etc. 20 Microns handles mineral trading for exports market. The Malaysia is holding arm for the raw material mining ventures, including 20 Micron, Vietnam, GTLQ, and IQ Marbles. On the right side, there are two strategic joint ventures. Partner 20 Microns, a German joint venture that supplies colored quartz catering to high-end surface application. A Seward 20 Microns building materials, another German joint venture focused on tile adhesives and advanced construction chemicals. A key entry into the high margin building material space. So now let's take a quick look at the broader industry in which our company operates. So the company primarily plays in the specialty chemicals and industrial mineral space. Now, to find data about industrial mineral space, it is very difficult because you have to see mineral by mineral. So it is not something which we can find it so easily. So we will look at specialty chemicals. It somewhat is hybrid into specialty chemicals and industrial minerals too. So this sector is experiencing strong global tailwinds, starting with the Asia Pacific specialty markets, As shown in the top left chart, the market was valued at 328 billion in 2023, and it is projected to grow steadily to over $500 billion by 2032. This translates to a healthy CAGR of around 5%, driven by rising demand across paints, plastics, packaging, construction, and automotive sectors. The bottom graphic, which it further reinforces that Asia Pacific holds nearly 50% of the global specialty chemicals revenue, making it the largest and fastest growing region globally. Now, looking at the market share by product type in the top right, the two segments that Microns, our company, directly is exposed to are construction chemicals and specialty polymers, also the dyes and pigment segment. These are the two segments which we are directly exposed to. Together, they account for a major stake of the market, which is demand, and the demand is fueled by urbanization, infrastructure investments, and evolving manufacturing needs. Some of the key growth drivers for this industry is rising infrastructure spending in India, China, Southeast Asia, increased use of performance enhancing additives in paints, coatings, and packaging, and a growing shift towards sustainable and value-added chemical solution. So, in this context, our company is very well positioned with its exposure to this high growth sectors and our ability to innovate through nano and construction chemicals. So, they are operating exactly where the demand is expected to be. These are some of the products which our company is doing now. These are very technical things, so we will not get into it, but there are dyes and agents and everything. So, this is what the company is doing right now. Now we'll see the management overview. So the company is led by a very seasoned leadership team, one that combines deep technical expertise with strategic vision. So who is the chairman and managing director, has been with the company for over 2 decades. He is a mechanical engineer with an MBA in finance. He has played a pivotal role in transforming our company into one of India's largest producer of industrial minerals and specialty chemicals. On the execution side, the company is led by Mr. Atul Parikh, who is the CEO and managing director. He has a background in chemical engineering and has international business exposure. Let's now see the historical performance of the company. So as you can see, the company has seen good growth throughout the years. Some years it is down just because there were some, what do you say, downturns in the entire specialty chemical industry. There was supply issue in 21. So these all issues persist, but still the company has managed to grow throughout the years, and it has delivered good net profits also. So this is the historical performance of the company. We'll move on to the key takeaways. So, takeaway is that this is a rare industrial compounder that's delivering structural revenue growth, not just a short term cycle. In FY25, they grew their revenue by 17%, reaching 912 crores. Importantly, they have guided for a sustainable 15 to 18% CAGR over the next few years, which is backed by both their traditional mineral business and newer high margin verticals. Second, while margins are currently stable at around 12.8%, around 13%, they are not peaking. There's a clear margin reset opportunity once their Malaysian mine becomes operational in FY26. So this mine is basically expected to reduce their raw material imports dependency and unlock 100 to 150 basis point EBITDA margin tailroom, provided their ore quality and logistics is solved basically. That's solved. But the nanomaterial business is no longer just an experiment. It has crossed 100 crores in revenue in FY25, and it is growing at 18% year on year. And with a fresh capex plan in it, it is becoming a core growth engine for with attractive margin for our company. Fourth, they have also entered construction chemical through a joint venture with Xavier, the German partner, as I mentioned previously. So this is a good move. The segment is sticky, margin accretive, and then launch in the tile adhesives is pretty live with liquids planned next. So next, even amid global freight disruptions, exports have remained stable at 13% of revenue. The company has adapted well by shifting from containerized shipments to bulk shipments, though this has temporarily increased their inventory and borrowings. Finally, in terms of business model, there is actually no directly listed peers in India. So this is one thing which is a bit this bit what do you say difficult about analyzing this sector. Basically, in specialty chemicals, all the companies are doing majority of their revenues coming from different types of chemicals. So it is very difficult to do a peer-to-peer analysis. So next, we'll see the some of the future takeaways. So the management has outlined a fairly clear and consistent outlook across the last few quarters. So they have guided for a 15 to 18% CAGR in revenue growth over the next 2 to 3 years. This is expected to come from both core mineral volumes, especially paints, polymers, and rubber, as well as their new verticals like nanomaterials and construction chemicals. In terms of margins, the company is currently operating at an EBITDA margin of around 13%, and the management believes that's sustainable in the near term. But once their Malaysian mining operations start contributing, likely from Q2 of FY26, they expect some margin expansion, possibly in the range of 100 to 150 basis point, depending on their, of course, on their core quality and logistics, which they save on it. The nano business, on the other hand, has already crossed 100 crores, as I mentioned previously, and it is expected to grow at a CAGR of 18 to 20%. They are also taking steps to stabilize exports, which is currently from 13% of their revenue, with bulk strategies, shipment strategies, and a pivot to Asia and Middle East. They expect exports to gradually bounce back to 16 to 18% once the freight issues normalizes. Lastly, while inventory and borrowing spiked in FY25 mainly due to raw material stocking, management views that as temporary. They expect working capital pressures to ease as mining ramps up and freight volatility settles. Overall, the outlook is cautiously optimistic, basically, with a strong focus on execution and cost discipline. Now, let's see the bull case. Let's talk about the upside, basically. So the first big lever for the company is margin expansion through mining integration. So the mine is expected to go live in FY26. If successful, this would reduce their raw material cost volatility and eliminate 30 to 40% of their import dependency. Even a 100 basis point margin uplift on a 900 crore top line translates to nearly 10 crores in EBITDA. So the second lever is the nano business. This is already at 100 crore plus scale, growing at 18 to 20%, margins about 12%. It's been scaled further through capex in high-end and adjacent products for rubber and paint. This segment alone could double over the next 2 to 3 years. Third, the severe joint venture in construction chemicals give gives them German grade IP, and it also gives them a clear route into India's growing infrastructure and formulation market. What's unique here is that it's not just a B2B play, they are building a branded portfolio which is rare in mineral based businesses. Fourth point, if you see, they have a deep client stickiness across tier one names Asian Paints, Berger, JSW, Basim, Finolex, with a multi product relationship across 20 SKUs. And so this drives pricing resilience, pricing power basically, and gives them an edge in cross selling. And finally, they are operating at 90% plant utilization. So as new verticals scale, operating leverage will kick in, improving return ratios from FY27 onwards. So next, let's look at the bear case. So we saw the bull case. Now it's important to also look at some of the risks that our company has. So first, the mine that we are talking about may not deliver the expected margin benefit. So if the ore that they are expecting, it isn't as pure as they are thinking, or the logistics don't scale up as they have planned, the margin expansion could fizzle out, leaving the business heavy on working capital but without a cost advantage. Secondly, both nano and construction chemicals, while they are exciting, still requires a long customer approval cycles. If these verticals don't scale quickly enough or face competitive pushback, especially from established players like JK, Pidilite, or Asian Paints, they may become capital intensive with slower pace. Third, that the balance sheet is temporarily stretched, so inventory has rose by 40% in FY26 due to bulk import stocking, and borrowings have jumped to 165 crores. If the freight issues continues or the top line slows down, this could affect cash flow conversion and dividend payout capacity for the company. Fourth, the core business is still heavily reliant on paints, which makes up around 48% of their revenue. With the paint sector currently is undergoing intense competition between Grasim, JSW, they are coming up with new them own brands. So this is creating a problem for a company because the pricing power becomes limited and the margin risk still remains. Fifth, and this is important from a governance lens, so the company has not provided clarity on some of their related party transactions. This is a potential bit of potential red flag, I can say, and it could lead. So this is one thing. Lastly, their core mineral SKUs like talc or calcium carbonate still face intense price pressures from unorganized regional players. So there is little moat in this commoditized segments, and it could dilute the marginless mix if not countered with value-added growth. So let's move on to our framework. Yeah. So IPO and fundraise history. So as per my research, there has been no any fundraise in the last few years. So I gave 5 and 5 score. The company is also listed way back. So moving on to the director and promoter track record, Mr. Rajesh Parikh, as we saw, is the chairman and MD. Mr. Atin Parikh is the CEO and MD, and Mrs. Sejal Parikh is the whole time director. All of them are good. They have 5% shareholding, around 6% shareholding, and the other shareholding is through other companies. So I gave 5 and 5 score. There is no such big problem. So related party transaction. So this is what I mentioned. So there was donation paid to their own trust of 30 lakhs. A sale of material and everything was there. So income of 1.4 crores and 47 lakhs. So related party transaction, although I gave 3 on 5 score compared to revenue, they are not very big right now, but I still gave 3 on 5 score here. Board composition, if we say it is a professionally managed company, there are in FY25, there are 8 directors, out of which 4 are independent, 3 are family on boards, 1 is additional director. So I give 5 and 5 score. Remuneration, if we say it is good, they are not drawing any percentage of sales, it is not very high. So I gave 5 and 5 score. Moving forward, a key person designation in January 2025, CFO had resigned citing personal reasons. Before him, in 2019, the resignation was there. So I don't think there is much of a problem in the company. But because the CFO had resigned recently, there were no specific issue except for personal reasons. So I gave 3 on 5 score. So moving on to the auditor change or resignation. So no, there were no resignation or change. So I gave 5 and 5 score. Auditor opinion has been unmodified. Credit rating has been good for the company. So I gave 5 and 5 score. Regulatory and legal issue. So what happened was the company had faced scrutiny from SEBI regarding compliance with some of their regulations. So they were also fined by NSE and BSE for non-compliance related to appointment of an additional director. The company had appealed to SED, basically Securities Appeal Tribunal, so which ruled in their favor. So I don't think there is much of a problem. So I gave 3 on 5 score just because it was related to compliance from SEBI. So I gave 3 on 5 score. Also, I would like to add one more thing here is that the reviews of employees on Glassdoor and Ambition Box were not that great. So this is one thing which I like to mention. So I gave 3 on 5 score here. Investor communication and disclosure, so PPTs and con calls and everything was there. But the PPTs and con calls were a bit inconsistent. So sometimes PPT is there, but the con calls are they don't do con calls. Sometimes con calls are there. So con calls they have been doing consistently for the last 3 quarters, I think. November 24 they did, and then I think in May month they did. So it is a bit inconsistent. So I gave 3 on 5 score due to their inconsistency. Now, moving forward to section 2, business concentration risk. So the reason why I gave 3 here is that there is no client concentration risk. So no single customer contributes more than 6 to 8% of the total revenue, but the company supplies to mostly paints industry. So as I explained previously, 48% comes from paint industry, 25% comes from polymers, and rest from other segments. So while paint-led positioning has historically been a strength, it also exposes the company to sectoral disruption which can happen there and pricing pressures also. Especially this is relevant, especially given rising competition from players like Grasim and JSW in in decorative paint segment. So this is the problem because of the paints. I gave 3 on 5 score. Revenue growth versus receivables, if we see, it has been good, so I gave 5 on 5 score. Now, there is one thing which we need to see, which will explain all the remaining three metrics here. The decline, if you see in operating cash flow by EBITDA, there is a decline. So there are some reasons behind this. So the management has transparently talked about it. So first is the inventory build-up. So their inventory rose by nearly 40% in FY25. This was mainly because of two things: a strategic shift from containerized imports to bulk shipments of purity raw materials from Southeast Asia, and freight disruption in the Red Sea, which led the company to proactively build a buffer stock to avoid production delays. While this was operationally good, it temporarily locked up cash that would otherwise show up in the operating cash flow. Secondly, higher working capital borrowing fund this inventory. Short-term borrowings were taken, and the short-term borrowing increased from 120 crores to 165 crores. This ensured that they can continue to do the inventory piling up, but it also increased interest outflow and temporarily weighed on free cash flow. So, third thing that I would like to mention is that this was very strategic and it is not a structural change. So the management has indicated that this situation is temporary. Once the captive mine begins in Malaysia by FY26, resilience of on imports will reliance on imports will reduce. So logistics will stabilize and working capital cycles are expected to normalize. Fourthly, if you see, there are no red flag on collections basically. The debtor days have remained stable. There is no significant increase in receivables. The working capital, the stress on working capital is largely due to inventory and not due to receivables basically. This is the reason why the operating cash flow by EBITDA has come down. So it also explains the increase in inventory days and cash conversion cycle. If you see, both has happened in this year only. So I still gave 3 on 5 score for all the three metrics, just to be safe. So that was the entire reason for all this. So moving forward to capex by revenue, it is good. So I gave 5 on 5 score. That is good. That interest coverage ratio is good. Liquidity position is also good. ROC and ROE. So ROC and ROE has remained in around 15 to 20%. So because we consider 20 and above a good 5 on 5 score, so I gave 3 on 5 score here. But if the Malaysia mines in the nano subsidiary, the revenue from it comes out and the growth happens as expected. So this ROE and ROC can increase in the future. Revenue growth, if we say, it has been a bit slow in FY23 and FY24. So right now it's good, but they are expecting a bit higher revenue growth. In FY25, it has reached around that. The management has said 15 to 18%. It is already at 17%. So it's good. The EBITDA margin has also been stable here. Just because of the fluctuation in revenue growth, I have given a 3 on 5 score. So after all this analysis, the overall score comes out to be 82. And for the
Thank
last
you, Om.
segment, valuation and
Looks
financial
like a very stable company growing at a stable growth rate. Regarding the product, I think it is more to do with micronization, minerals, etc. And they fall somewhere in between commodity chemical and specialty chemicals. They are trying to move higher in the value chain slowly. So let's see how that plan pans out. They have done the capex, but PE of 13. They have historically been trading at that PE range. I would like to see what happened in FY 13 because there was this huge drop, then long consolidation, and then post COVID, most of the stock got re-rated. This also got re-rated, but P looks like around 10, somewhere around there. It is trading. If you're taking 1 year forward view, they are expecting to grow at the minimum rate of 15%. So considering that, let's be conservative and take 1,000 crores as the revenue they would do next year.
margins they are expecting to maintain at the same rate in spite of the capex. So it's also, the margin has also been steady over the last couple of years. PE, I would give it at least a 10. It's giving a price target of 204. It's trading at 222. So a lot of re-rating has to happen through the PE re-rating. For example, if it goes to 20 or something, look at the effect of price target, it doubles. So basically, two, three things as we have observed. One is the huge capex they have commissioned. I'll keep a close eye on that, see how that plays out and how that impacts the margins. If margins expand, then PE re-rates, and if they're able to maintain and move up the value chain, then they definitely require to command a higher multiple. And the second is on the inventory days. There has been increase in the cash conversion cycle for strategic reason the management mentions, but this is something again I would keep a close eye on. Also, I would like to read those employee review to see what they're talking about the management. That's a good insight. When it comes to reverse DCF, free cash flow is negative because of the huge capex they're doing. Our cash flow from operating is 32 and their profit before tax is 83. So lesser of conversion is happening because of higher inventory, and net profit is 62. So I'll just take net profit to be in between. So if the net profit is 62 and here our required rate of return is 20 and terminal growth rate is 3 and our holding period is 5, and 10 PE at the end of 5 years. So basically the implied growth rate should be 15%. That is what the management is expecting as well. So at this current price, looks like a reasonable risk reward, and also their focus on sectors like construction, which is really doing well, and diversifying the base, etc., should bode well for them. So let's see how that pans out. And the score, overall factor score also is good.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.